willful breach.
International Monetary Fund says central banks should not rush into rate cuts. Central Bank of Nigeria sets $1 million as capital requirement for international money transfer operators. More than $70 billion mobilized to unleash Africa's food production potentials, says African Development Bank. Oil prices gained after OPEC Plus maintains output cuts. And on the program today, we shall be taking a look at issues of economic growth. And we have the Chief Executive Officer of Nigerian Economic Summit Group, Tayo Aduloju, to do justice to this. The program is Business Express, reaching you from Abuja, Nigeria's capital. I am Musa Abubakar, your guide. Now let's talk business. The International Monetary Fund (IMF) says it sees a greater risk to the global economy if central banks start cutting interest rates too soon than if they move slightly too late. Managing Director Kristalina Georgieva said this Thursday during a briefing at the International Monetary Fund in Washington, where she noted that the U.S. Federal Reserve, the European Central Bank, and others have held interest rates elevated in recent months in an attempt to bring inflation back down toward target following a post-pandemic surge in prices. With inflation now falling in many of the world's advanced and emerging economies, attention has now turned to when they should start cutting rates to stimulate investment and economic growth. She says, and I quote, "Our team has looked back in history, and the conclusion they drew is that the risk of premature easing is higher than the risk of being slightly behind." The Central Bank of Nigeria, CBN, says it has established a minimum operating capital requirement for international money transfer operators at $1 million for foreign entities and equivalent amount for local operators. This significant development was outlined in the revised guidelines for the operation of international monetary transfer operators, which were officially released on January 31st, 2024. According to the guidelines, applicants must adhere to the CBN's anti-money laundering, combating the financing of terrorism, and countering proliferation financing of weapons of mass destruction regulations. These regulations are detailed in the CBN guidelines for licensing banks and other financial institutions in Nigeria. The operators intending to operate in Nigeria are required to submit their applications to the Director of the Trade and Exchange Department along with various documentation. The latest central bank intervention is yielding positive result as the pressure on foreign exchange reduces. Now let's see the report. exchange rate rallied to around 1,320 naira to a dollar during midday trading at the official market. Financial analysts attributed the decline to later CBN intervention through a circular to address speculation and hoarding by banks.
The last financial year, you will have noticed that deposit money banks, in the main, recorded supernormal profits. All these profits didn't come from the primary function of banks, which is intermediation. The profits came more from speculative activity. In other words, foreign currency holdings were translated at the prevalent rate of the naira at the close of year, and this translated, as it were, to supernormal profits for the banks. What the CBN is essentially saying with this policy is that we're going to put a constraint to the amount of FX holdings that you can have in your books. So your short positions, your short open position, should not at any point in time exceed 20% of the bank's shareholders' funds unimpaired by losses. And then for the long positions, it's zero. Meaning, in other words, that you can hold idle FX in your books.
The new circular introduces a set of guidelines aimed at reducing the risk associated with speculation and hoarding practices. As a currency, the naira paid some of its recent losses against the dollar on Thursday as market digested the latest policy decisions from the Central Bank of Nigeria to prop up the country's embattled currency. Let's now see how much is the naira exchanging for the currencies. Now, earlier today, my colleague Benny Adams had a conversation with the Chief Executive Officer, Nigerian Economic Summit Group, on its 2024 economic projections and issues that will shape the economy this year. Now, take a listen.
It is that time on Business Express where we take a look at the economy, particularly the projections, talking about the real GDP for the year. It is akin to every beginning of the year, though this is February, but to plan ahead of the year, talking about first quarter, second quarter, third and fourth quarters. And I have with me in the studio Dr. Tayo Aduloju. He is the CEO of the Nigerian Economic Summit Group. You're welcome to Business Express.
Thank you for having us.
Well, we've had a projection talking about the real GDP growth from 3.2% up to 3.7%, coming from the IMF, coming from the World Bank. The federal government is got a target of as much as 3.7% for the NESG, who are key partners in this Nigerian project. You're projecting 3.5% growth rate. Can we know what parameters you used to arriving at this projected growth following what has been experienced on ground? Yes, there's been reforms to ensure that the economy comes back to sustainable pathways of growth, talking about the unification, but yet inflation is on the rise. Can we get to know some of the parameters considered to arrive at this projection at this time?
Absolutely. And again, thanks for having us. So our 3.5 GDP projection for 2024 is premised on, we project that reserves will move up to about 40 billion this year. We project that inflation will settle around 21.5%. And we think that this is going to happen within an environment that is more calibrated for dynamic reforms in 2024 now that the new administration has settled down. And so we think that that will possibly stabilize exchange rates at about 900 to the dollar. And this is premised on a philosophy that we've shared in terms of a framework for economic transformation in our Outlook report. We think that the extreme macroeconomic instability we saw in the last year and its accelerators, especially the inflationary accelerators, will slow down. An upside on GDP, for example, is as the oil refining sector kicks in and becomes productive. We'll see the positive effects on the manufacturing sector and on price of transportation, for example. And we think that on inflation, clear forward signals from the central bank now in terms of both its target for inflation and the measures it's going to take to tackle them sets us on a pathway to the interventions that, of course, drive inflation downwards. We've seen, at least in December going into the new year, a determination to clear backlog. Whilst liquidity remains a challenge, there is now at least a set of clear actions both on the fiscal and monetary side in terms of an emergent liquidity management strategy. What we've said in our outlook is that if you think of the economic transformation of the country from where we are in 2023, which is exacerbated inflationary pressures, especially felt by businesses and households, plus that incredible volatility we saw with the FX reforms. Those clearly were signals that in the short term were impossible to manage. And I think we noted that last year in our outlook, media outlook, that the volatility will be sustained. But as we go into this year, policy positions, fiscal positions from subsidies that have now seen FAC allocation, for example, improve, creates some upsides, especially in government's capacity to pursue its programs. Having said that, it's crucial to note that a reform stance for 2024 that we factored into our model is a dynamic reformer stance. In other words, government will focus on stabilizing the economy as a fundamental thrust of its economic policy and strategic posture. That requires that there is strategic intentionality in creating a national liquidity strategy, which gives you a pipeline and a line of sight to FX, a clear spending plan that ensures that our resources are deployed and expenditure transparency, accountability and efficiencies are at their highest, and a clear borrowing plan in terms of where we would seek resources from, supported by a clear investment plan that allows national assets to sweat to create the external liquidity required, with a strong stance on trade policy in terms of non-oil expansion, in terms of export trade. We think
sorry, let me hold your thoughts at this point so that I don't get to miss traction. The fact is, a lot of these reforms are ongoing. It started with this administration, it started with even the previous administration before this, and we have seen a lot of this being enforced towards the end of last year to early January, talking about the new year. The expected impact is what Nigerians are looking out for. Possibly looking at the forex market, it's an issue. We've seen government planning to collapse the parallel market with the official market. There was a deadline for December. Now going into the new year, January, ending January, now we're in February, the first few days of February. What we are seeing in the market is not encouraging. And Nigerians out there are saying, what are the issues? We have these reforms on ground. Is it about the implementation, or is it some level of miscalculation? Now there has been the advocacy for a proper handshake between monetary and fiscal policies. Are we having that ongoing? Which is the way to go at this point?
I think that there are two things that require pragmatic coordination. Fiscal and monetary policy must coordinate. But more importantly, you need to have clear policy communication, consultation, and coordination. Communication, because a lot of forward guidance is taken by investors as to whether to invest in Nigeria based on that clear communication. Consultation, because the very nature of policy making in a volatile environment must be consultative. You must carry people along. If not, even good intentions will trigger wrong signals or will be perceived as wrong signals. And then, of course, you will get unintended consequences in market response. Okay? The last is coherence, right? You have to implement a set of well-bundled reforms together. This is where, for example, the handshake you discuss between fiscal policy and creating liquidity, a clear liquidity strategy that gives you line of sight and then monetary policy providing some clear communications plus consultation. So, for example, in the last 48 hours, we've seen some new rules and directives issued by the central bank. Whilst they look well-intentioned, the consultative approach of getting to that, how they are communicated, the feedback mechanism to take that in and respond, right, is crucial to creating stability. And stability is the key in the first instance. And so when you ask why some of these things have not worked, is we're not seeing the level of coherence required and coordination to make it work. And those are crucial parts of, like I said, the reform dynamic stance that must be maintained throughout 2024. We must see clarity in terms of communications. For example, we must understand what the line of sight is in terms of an investment stimulation and promotion plan. We must see within that plan how much of that will impact liquidity and liquidity projections, maybe quarter by quarter. That has to be tied, like I said, to clear spending and borrowing plan. And so this is beyond the broad policy framework now. This is now pointing to the specific objectives that can be tackled in terms of economic policy coordination, both from trade and fiscal, but also from the other pieces of economic policy that deal with investments specifically that need to come into the country and be sustained. And you need to do that in an environment where, you know, businesses have taken a big hit in terms of, if you look at the cost of doing business, the combination of inflation, exchange rates, interest rates, and, you know, the deficits in infrastructure, cost of doing business, corruption, etc., insecurity, all build to create that exacerbated situation that you're talking about. So so you even need coordination amongst non-economic authorities, for example, on security or on market regulators. So this is tough times, tough headwinds, deep waters. It requires that all hands are on deck, and that what we are seeing, for example, if you just take revenue risk, for example, that's triggered by oil theft and sabotage to oil infrastructure in Nigeria, that's a national security imperative. That has to come alongside your economic projections to make that work. We've seen military operations in the oil-producing parts of Nigeria drive improved production levels, at least from what we saw early last year. So those are good signs, but they need to be sustained and need to go further to end the sabotage. So I think what you need in 2024 as a posture of government is a strong radical reformer stance, clearer policy communications, almost on a weekly basis, clearer coherence in terms of how the sequence of fiscal, monetary, trade, investment, and industrial policy work on a week-to-week, month-to-month basis to move us out. Lastly is the idea of how much vulnerable Nigerians are. We've created a very large vulnerable population. 107 million Nigerians are monetary poor, 133 million Nigerians are multidimensionally poor. Now, what that means is that social investment programs, which are your short-term buffers to cushion the effect of these structural reforms that take longer to kick in, must be efficient. They must be transparent, they must be efficient, and the transmission mechanisms must reach the citizens that are the most vulnerable. This is something that is not an afterthought. It must come alongside the structural reforms if we are going to be able to pull everyone out together. The last thing to think about is the stimulus for the sectors that were formerly high growth sectors, but in 2023 became stagnated. So in 2023, ICT, finance, and trade remained the sectors that were still drivers of growth. Agriculture, manufacturing, most of the services sector went into stagnation. And of course, oil and gas remain in recession. The market regulation and market regulators need to collaborate with fiscal and monetary policy to look for how to stimulate these sectors to go back into the high growth, high impact regions, especially because the sectors with the highest labor intensity are the sectors that we're now seeing stagnate. So we need to adjust that. And to adjust that again, it's not simply monetary policy signals, which is important and crucial, and fiscal policy signals. It's also the coordination of all these key market regulators that must do their part.
Thank you, Dr. Tayo Duloju, CEO NESG. On behalf of myself, production crew, and a good number of Nigerians, they want to appreciate what the NESG is doing for the growth of Nigeria. Thank you for sharing your thoughts with us.
Thank you very much. Thank you so much.
Moving on, let's now see how commodities are trading around the world. The African Development Bank says following its Dakar 2 Food Summit, it has been able to mobilize over $70 billion in an unprecedented global effort to boost food production in Africa. The FDB President Akinwumi Adesina stated this when he received the Africa-based Directors General of Consortium of International Agricultural Research Centers at the bank headquarters in Abuja to forge ways of scaling up food and agriculture productivity on the continent. He stated that AFDB Group and the Consortium of International Agricultural Research Centers are committed to strengthening their collaboration to increase food production and provide better nutrition for Africa's growing population. He noted that with 65% of global uncultivated arable land, the bank believes that the continent can feed itself and rest of the world. The centers are located across African countries and focus on enhancing food and nutrition security, reducing poverty, and improving natural resources and ecosystem services. He stressed that they are critical to achieving food security on the continent, just as their counterparts in Southeast Asia and Latin America were also key to accelerating agricultural growth and food self-sufficiency. Now let's head to the capital market, where the Nigerian Stock Exchange ended the last trading day for the week in positive territory with an all-share index of 104,000 basis points, a total of 943.5 million volume of shares valued at 23.4 billion naira in 11,512 deals exchanged hands at the close of trading for the day. Market capitalization stood at 57.1 trillion naira. Well, let's head to the global stock market where Bossade is standing by. Bossade, I understand that the bulls are pushing up the sentiments. Well, you tell us.
Well, Musa, I must say all attention tilted towards the central bank as the Bank of England on Thursday held interest rates steady with an unexpected split vote that highlighted the tricky outlook for policymakers as inflation moved closer to target. However, European market moved higher on Friday to close out a busy week of corporate earnings and major central banks decisions. DAX rose 0.75%, FTSE 0.21%, and CAC 40 of France also topped 0.51%. For Asia, the Continental Blue Chip Index rebounded Friday after closing down 0.5% the previous session, pulling back from the 2-year highs it scaled in late January. However, Japan's Nikkei 225 rallied 0.41% at 36,158.02, while the Shanghai Composite dipped 1.46% at 2,730.15, and the Hang Seng Index followed suit at 0.21% at 15,533.56. U.S. S&P 500 futures rose early Friday as investors looked ahead to January jobs report. Futures tied to the Dow Jones Industrial Average topped 0.97%, and the Nasdaq followed at 1.30%. It was a mixed performance for Africa's stocks, with South Africa's JSE Africa Top 40 and Namibia Overall Index posting 0.77% and 0.27%. That's the performance for today's trading section. I am Bossade Abel. Back to you, Musa.
Well, Bossade, thank you for that update. Well, let's do this again on Monday at 3 p.m. Enjoy the rest of your day and have a lovely weekend.